This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, put your seats in the upright position because we're about to land this thing. And from this week's data, it all looks like it's probably going to be a soft one. We'll see. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and well, it's still January, but I'm going to skip ahead a little bit because from a financial and an investment perspective, I feel like today, Friday, is Groundhog's Day because when we get the December reading on the PCA inflation data, we got it this morning, and therefore supposedly we know if we're going to get interest rate cuts soon, or if we'll have this longer winter and we'll have to wait until at least later this year for those cuts. Well, guess what? The rodent did not see his shadow, and inflation in this report, and this is, again, we say it over and over again, it's getting boring, but this is supposedly the most important reading of inflation that the Fed depends upon. Well, it was even more benign than expected. The market's reaction actually pretty muted. When I stepped in here to record, I think the indexes were mixed. Bonds were actually off a little bit, meaning interest rates are up a little bit. A sign perhaps that, a lot of good may have already been cooked into these estimates. We used to talk about, 15 years ago, it was very popular to talk about the so-called whisper numbers on earnings because stocks had run up so much before the earnings and the earnings estimates were not the real estimates. Well, maybe we have whisper numbers for inflation, but perhaps we'll see the market rally later this day, and that's all moot. But either way, it was a pretty good sign that those that expect more from the Fed this year, more and sooner, they might be on the right side of this overall wager. The core year-over-year rate of inflation stated in this PCE deflator was 2.9% versus the consensus, according to FactSet, was that they expected it to be 3%, and the prior reading was 3.2%. So now that we've cracked that 3% barrier, we have inflation below 3%, it's noteworthy that this is also, or was also, the lowest reading recorded since March of 2021. Now, this commonly now brings into discussion the so-called neutral rate. The terminal rate, also known as the R-star rate, different terms for the same thing. That's the level at which the Fed's interest rates, where they set that overnight rate, it would neither, when it's neutral, neither pump up employment, boost employment, nor would it be boosting the economy, nor is it going to tackle, on the other side of the seesaw, is it going to be high enough to push inflation lower. So it's it's not going to combat inflation, it's not going to combat or help in unemployment. It's neutral because it's the rate at which the Fed is ostensibly not having an impact on either side, and the economy is supposedly then, in theory, running fully efficiently, which is not where you always want it. Sometimes you need to boost employment levels. Sometimes you need to attack inflation, but efficiently meaning both are in perfect harmony. But since there are limitless other factors that impact the economy over any given measure of time period, this is really more theoretical than anything else. So there's really no way to perfectly calculate it. There's no formula that will put this really out there accurately. But despite that, the Fed does publish their estimate, their best guess as to what it may be at any given time. And while that all might sound pretty kooky, especially for something that's at the end of the day pretty important, it's important because it's part of the formula when assuming, versus everything else that we do know, where they're going to go from here. For example, with this PCE number now at 2.9%, and the Fed's stated goal is to see inflation go to 2%, knowing that the Fed said just in December that their estimate, their published estimate for this neutral rate is 2.5%, and knowing that the current overnight Fed rate is 5.5%, therefore we have 3% to work with before the Fed gets to their expected neutral rate. In a nutshell, the Fed can, in theory, now comfortably give some relief to borrowers. They can help the economy continue to grow by cutting up to 3% before they even reach zero. They can go up to 3%, and theoretically, they would still be on the side of the equation that is trying to lower inflation, just as not as strongly as they are now. Now, since they still want inflation to be lower than where it is today, they wouldn't want to race to 2.5%. They don't cut overnight 2.5%. And they, too, are aware that this 2.5% estimate is imperfect. They know that this neutral rate isn't perfect, but they can probably get comfortable now cutting rates probably up quarter point at a time, and while reevaluating along the way without any real shocks, at least if they don't come, it's easy to imagine them cutting 1%, maybe 1.5% before really having to consider changing their course. They can get from 5.5% down to 4.5%, maybe 4%, a number that's still well above the neutral rate, but get us there without having as much pressure on the economy. And this still keeps us well within the normal historical balance for interest rates and should not be confused with that zero rate environment that fueled asset prices for more than the last 10 years. That is not normal. We are not just waiting long enough to get back to that accommodative period of interest rates near zero, of mortgages at 2-ish%. That is not normal. According to Howard Marks, in the fourth quarter commentary he published over at Oaktree Capital, the normal range for Fed funds rates is between 3% and 8%, not 0 to 1%. And that today at 5.25%, we're basically at the median rate for that normal range. Meanwhile, a week ago, the S&P 500 made its first new all-time high since January of 2022. In fact, the Russell 3000, which is a massive index of all sorts of stocks and sizes and such, also just recently made its first all-time high in a couple of years. And, it may symbolize, and it is being used to symbolize, the official end of the bear market. But since we are now 35% or so higher than that trough bottom we made in 2022, I think the bear has been over for a while now. And now we may also want to question where we go from here. But that is definitely not to say where we go is lower from here, as we've now clawed our way back to these new highs, but stand here today with interest rates 5% higher than they were when that previous high was made over 2 years ago. Inflation is still higher than it was. And earnings growth is seemingly now accelerating in many areas, while these rates and inflation begin, in theory, a downward trend of some degree, a degree which remains under debate, of course, but there's plenty of reason to believe we improve from here. It becomes more supportive of asset prices from here, depending on how much good the market has already priced in right now. So to put the wraps on 2023, a year in which so many were convinced the economy was going to enter recession, at least by the fourth quarter of last year, if not as many thought by the first half of last year. Well, the U.S. economy grew 3.1% for the entire year per the recent GDP data reports we received this last week. And what's particularly remarkable about that number is that when so many are sold on recession, it affects behaviors. Especially, this isn't just people who prognosticate about the stock market, but on a corporate level. It affects corporate behavior as well. And when those folks are wrong, as they were in this case, not always, but in this case, and if they had been preparing their large corporation for leaner times and instead find themselves with barren shelves, they have these light inventories right now, and they have to scramble to catch up for an economy that's doing better, that there's better demand for their business than they expected, well, that ultimately then leads to further economic growth, just as anticipating a recession helps lead to one. The year was capped by a fourth quarter in which the economy grew at a 3.3% seasonally and inflation-adjusted annualized pace, and households and government spending continues to rise right now. And this is compared with current average estimates, which according to FactSet, we're looking for 1.6% GDP growth in the quarter. Also, according to data that was made available by the Federal Reserve Bank of St. Louis, total U.S. household net worth is now up to what I think is a staggering $154.3 trillion, about triple where it was 10 years ago. And a good deal of this is attributed to households, actual houses, real estate valuations, and the stock market going up, which reflects also overall savings and net worth. That's quite a number, although, I am generally pretty alarmed often by the total levels of debt held by households, and we're seeing more of that now. And of course, alarmed to say the least by the amount of U.S. National debt. This almost $160 trillion does at least help give some perspective to that as well. This should remain in our minds and give us perspective when we hear so many of those voices calling for this slowdown in 2024, same voices that called for it last year, in the face of this momentum in the economy, coupled with an anticipation of interest rate cuts, as well as this tax bill that's about to be passed, seemingly. Can't guarantee that, but seems to have pretty good support, and that's going to inject even more momentum into the economy and ultimately into corporate earnings. So, as I said a moment ago, they're now officially calling this the end to the bear market, 35% off the lows that were made a little less than 2 years ago. But while I keep repeating and questioning how much good is already priced into some of these stocks, from a historical perspective, we shouldn't just naturally be scared of a rally after a bear market. We shouldn't question whether or not it's sustainable. We shouldn't make all-time highs now and just assume that the market is near its near-term top, at least. According to a chart that was published by Ben Carlson, who's over at Ritholtz, the data he put out said after a new high has been achieved following a bear market, using data that went back around 70 years, following that new high, so after the 35% we've already made, the average 1, 3, 5, and 10-year total returns were 16%, 27%, 59%, and 206%. And in one sense, this can mean simply that capitalism works and stock markets tend to go up over time. But note that for these periods, the annual returns average over 10%, and simply an average annual over 20% for that 10-year time frame. And that's pretty easy to boil down. It's not that surprising that if you remove the bear markets from the equation, from the history of the stock market, the bull market years provide pretty good returns if you only use them. But what's maybe more notable here is that in most cases, there aren't snapback rebound bear markets following a bear market like this. The major price corrections of that bear market are generally, not always, generally enough to provide clear sailing for many years after that big bear drawdown, with a notable exception being the bear market that ended in 2002, which had really following that, that was the dot-com boom, September 11th, that really bad time followed that, really had poor returns for the 5 years following that period. But even then, still an exceptional 10-year report. I think it was over a 10-year average return for the following decade. I guess my lasting takeaway today, and then I'm going to take a quick break and come back, but the overall takeaway is that it always boils down to controlling time horizons. Don't spend too much effort, and certainly don't make concrete decisions based upon your impression of what the road immediately ahead of you is going to bring as far as the markets. But instead, think about your capital, your savings, your investment money in terms of usage, not even necessarily your age, but instead, think about this pot of cash is it one that you need over the coming year? Is it one that you can expect to be drawn upon over the next few years? If that's the case, then take advantage of these higher interest rates, earn some interest on it with little risk, but keep it very, very safe. But if these are deposits that are for 5 years, 10 years before they're called upon, maybe an indefinite period of time in which you want to build value and kick off compounding amounts of interest and dividend payments, then avoid the near-term forecasts and instead invest it in this system that's seemingly undefeated over longer periods of time. All right, with that in mind, I am going to take a quick break. I'll be back in a moment. For the Wise Investor Show, this is Chase Hinderstein, and I'll be right on back.
Don't be forced to sell stocks in a bear market. Now is the time to review your financial plan and determine how much liquidity you truly need. I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know about them. To learn more about how to manage your cash flow and to become a better informed, wise investor, listen to the Wise Investor Show at thewiseinvestorgroup.com or find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. In addition to the inflation data and the other economic points, we've continued to get stronger and stronger consumer confidence and consumer spending reports over the last couple of weeks. And if we're seeing consumer confidence accelerating, taking off, and also the Fed's going to lower interest rates in addition to that, providing more liquidity into the economy, how are we going to see inflation continue to trail off towards that stated goal that they hope to not achieve this year, but to get to 2% inflation in 2025? How is the consumer, some of which are running up debt and some of which are richer than ever, based upon what I was saying earlier, how are they not going to drive inflation higher, especially when they're getting bigger child tax credits now and companies are going to get bigger tax breaks than they've recently had? Well, for one thing, a chunk of the inflationary cycle, which we saw inflation peak over 9% over a year ago in the U.S., some of it was obviously driven by the supply chain being blown up and disrupted during COVID. But that effect has largely been reversed. I mean, there's certainly some problems that will persist, not because of COVID, but because of some of our other problems. But most of that inflationary effect has been reversed. The inflation that we're seeing that kept it above 3% or keeping it around 5%, that was due to wild pumping of liquidity into households and into banks and spending. And an element of that, which still remains, is the low inventory rates in the businesses that anticipated a recession that I was talking about. But while inventory rebuilding can accelerate the economy, it can also heat up inflation when matched with an exuberant and liquid consumer. But the box that's being checked for now that's still in the lowering inflation's favor is that the U.S. dollar has been ostensibly getting stronger, which is a negative for some U.S. multinationals, but overall a plus for the American consumer buying imported goods. And we're also importing Europe and more of Asia's economic stumbles as the U.S. economy has chugged along without them. And that right now might be the only thing that's allowing us to kind of thread this needle to justify accelerating growth along with even lower inflationary prints. That's the seat in the upright position, buckle your seatbelt, here comes what looks to be a soft landing. Today, the dollar is up about 2% to start the year versus the euro and the pound, while it's 5% stronger versus the yen right now. And I'm not going to start today or really anytime soon getting into foreign exchange effects on this show. But what's allowing for this to work for now, what's seeming to permit the coveted soft landing, is that we are feeding off the economic stumbles or struggles in other parts of the world, which is fueling deflation on a global demand trend to some degree. And I say that because while the economic struggles in China are notable, they're also in the face of some strong pent-up spending being released at the very same time after their draconian policies that they employed during the pandemic have now worn off. Basically, their economy is really not doing well today, but because of the scale of the economy, billions of people, those that have liquidity, while you might say a billion people are doing quite poorly, there's still a couple 100 million worth which have pent-up demand, some liquidity, and they're out and about spending. But the overall measurements are allowing for at least not causing inflationary pressures right now. And, it's a bit of a Goldilocks scenario for the U.S. for now, but a precarious one. There are still extraordinary tail risks in the world, and that might be obvious, but I do think they're seemingly worse now than is typical, which not only provide the daily horrors that we see in the headlines, but provide existential risks to global supply chains, to commodity prices, and worse on an economic level, and in many different corners of the globe. Overall, today's outlook, the bottom line of the show hopefully conveys through, is one of optimism, where we see the monetary climate improving in a path where it can ease pressures on the economy while the economy doesn't have to stumble for us to get there. But as always, it's a mixed and cautionary message. And that lesson about time horizon before the break, so that you don't leverage to any given thesis and that you protect your assets first without letting what may start looking more and more like the fear of missing out taking over. I've painted the picture of why the next decade is likely to be a good one for stocks. But even if that is very convincing, you shouldn't take on more than a level of exposure to that risk than is appropriate and hopefully well thought out and developed by you and any advisors that you may use. All right, that's it for me today. Thanks for tuning into today's show. I appreciate that you spent some time listening in. For the Wise Investor Show, I'm Chase Hinderstein.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.